producer. As most of the country remains in lockdown and working remotely, this afternoon we're going to be looking at what might happen to the mortgage and buy-to-let markets if the lockdown continues and more lenders pull out of the market. Where indeed will that leave brokers, but more importantly, where will that leave your clients? Joining the webinar today to discuss these questions and more are economist and chief executive of Landbay, John Goodall, and Landbay chairman and mortgage funding expert, Tony Ward. Now, we've had hundreds of questions submitted and we're going to be trying to cover as much as possible over the next 40 minutes. But to start us off, let's begin with a look at some of the macroeconomic issues that are facing us all. We've seen interest rates are now at record lows, the lowest level in the Bank of England's 325-year history. But why haven't we seen product rates fall? Tony?
Yes, so thanks, Robin. I think the answer is just because bank rate, or base rate as most people know it, has fallen, this hasn't transmitted itself through to a fall in the cost of funds for most lenders. So if you look at retail funded lenders, for example, there's frankly a limit to how low you can push savings rates without losing the deposits to other lenders. And I can assure you that right now, banks and building societies will be alert to maintaining liquidity as a priority right now. And the Bank of England is aware of this, and that is one of the main reasons why they have relaunched a version of the term funding scheme that was due to run out in 2022, actually. This is a mechanism where they provide liquidity to some banks and building societies, not all of them, those who are eligible, at subsidised rates. It's a flat bank rate. And this provides both liquidity to them to make loans and allows a mechanism to transmit these low interest rates through to borrowers. Now, for non-bank lenders, cost of funds is set by the wholesale markets, or tends to be. And if anything, those costs have risen over the onset of the crisis as fewer investors have been around, and it's simply just supply and demand, really. So although bank rate has fallen, cost of funds has in fact risen for those lenders. And I think finally, some lenders will be using rates right now to dampen down demand for new mortgages while they fully implement remote working, digest new payment holiday rules, and assess sustainability of their businesses as the lockdown bites.
John?
Yes, as Tony said, I mean, obviously the Bank of England rate also only affects banks funding. And I think that's worth mentioning here is that banks haven't been tested in the same way operationally in terms of working from home before. So even those that can access that liquidity, they may not have the operational ability to lend in as higher volumes as they have been over the last few years. So therefore, they probably want to stem the flow of business in so that they can just actually cope with an operation where workforces may be entirely working from home, or in some cases, they're only running at 70% staff, et cetera, et cetera.
Now, I've just had a question come in from Ronnie Armstrong from Truly Online. Ronnie wants to know how the current lender reaction to the COVID-19 crisis compares to the financial meltdown of 2007 and 2008. I don't know if Tony, if you want to pick up on this.
Well, yeah, so this is very different, isn't it? Last time we had a lender-led crisis, imprudent lending, which was a credit crisis, and then that became a liquidity crisis, a global liquidity crisis. Now, this time, COVID-19, it affects absolutely everyone on the planet, and the effects have been felt rapidly. So no doubt there will have been some overreaction to markets. There always tend to be, both on the down cycle and the up cycle. And that might ease as we get over the initial shock of this country and other countries being in lockdown and the situation. But the long-term social and economic effects are still being worked through right now. So in a sense, the banks and financial institutions are part of the solution to this, along with governments and central banks, to help ease the economic burden, keep the wheels turning until science or herd immunity can rescue us. That's really the resolution. Is sort out COVID-19 or for it to sort itself out over time.
John, do you have anything to add to that? How are you finding this very different from 2008?
Well, to be honest, I wasn't in the mortgage industry in 2008, but the thing to point out is that in 2008, mortgage lenders were largely to blame for the crisis. And so it was an industry crisis that caused everything. And businesses went insolvent very quickly, funding dried up extremely quickly as well, whether they were banks, obviously, who got nationalized, or non-bank lenders that ran into problems as well. This time is different. You know, the mortgage industry is a victim in the same way as other, from an economic point of view, as many other businesses are. You know, this is a public health issue, and I think the challenge, as I was saying earlier, for the industry is you're hitting a time of economic stress when people are being asked to put their BCP, business continuity plans, into place, which may not have been tested to anywhere near this extent, where everyone is working from home from an extended version, and business volumes will be dropping materially. And then on top of that, and before we go into funding costs in more detail, on top of that, the payment holidays that the government has introduced for both homeowners and buy-to-let landlords means that the call volumes that lenders are seeing is spiking hugely. So a lot of lenders are, rather than focusing on new origination, are focusing just keeping the wheels turning, being able to deal with their current customers.
It's really interesting. But Tony, what do you see happening to the mortgage market due to COVID-19? What changes do you see?
Well, I think the way I've seen it, it's sort of seems to me it's in sort of three phases, and we're still in sort of phase one at the moment. So phase one was disbelief and shock. I think we'd all seen the COVID-19 situation in China building. There was somehow a view that this was a Chinese problem, it wouldn't come over here. And that's rapidly led to lockdown of the whole country and other countries. And then having to digest that news so quickly, implement working from home strategies. So, you know, we've all had these disaster recovery and contingency plans. Well, this is probably more severe than a number of those plans that were in place. So you've had to adjust to how do I deal with the operational infrastructure aspects of working from home? How do I deal with the here and now is a lot of what it's about. What about all these new rules that have come out from UK Finance and the regulators on how to treat customers? What is the financial ability of my business? How long is this going to be around for? So that was phase one. A number of businesses are still in phase one. Others are moving on to phase two. Phase two is, okay, so we've managed to survive so far. We're operating externally. We now need to attempt to trade. So a lot of focus inevitably will be on, well, bits of the market that aren't functioning properly, like surveyors and valuers, and we'll talk about that shortly, I'm sure. How do we get back all these things that we rely on in the market? There'll be existing pipelines of business, pre and post offer. I suppose the most obvious part of the pipelines to focus on will be the post offer and the remortgage pipelines. So how do I get the valuations on the pre-offer to try and get my pipeline to complete? What I think probably hasn't been focused on is, well, that's all very well, but as things stand, once we've worked through the pipeline, there's going to be very little activity in this market. People are not going to be buying and selling houses for some time. So we may not need a lot of valuations once we get through the pipeline, until we can have some sort of reasserting some form of normality, however long that is. And then finally, phase three, in my view of the world, is a recovery phase, which is, okay, we hunkered down, we worked remotely, we dealt with the shocks, we completed the business we could, and now there's some form of recovery. People are going back to work, the economy's begun to work. How quickly does that happen? And how does my business take part in that? So I still think we're early phases in this. Some companies better than others.
Indeed. Given the current crisis is much wider reaching than the credit crisis of 2008, From a corporate point of view, how do you see this affecting lenders' ability to lend? Or is there going to be a stage when they run out of money, perhaps?
Well, so you know, I suppose on this point, obviously there's a bank and a non-bank lender element here. Obviously, banks are getting liquidity pumped into them. Most banks are operating at fairly healthy capital ratios right now today. Obviously, I saw the news today that banks are not paying dividends. So again, that will bolster their balance sheet as well. And in terms of sort of lenders, most lenders do operate an annuity business model, so that they're making money and revenue from the loan book that's outstanding that they're servicing as well. So that there is, even with no new lending, there is some sort of income coming in. I think where the challenge is for the non-bank lenders is that the cost of funding from capital markets has gone up significantly. The securitization markets are closed, so they'll be thinking ahead, thinking, well, every time I'm lending, I've got to think 6 months, 9 months down the line. I'm building up a pool of mortgages. How do I get to a certain point where I just have to stop because my warehouse is full, and the warehouse stops at a certain point, and I just have to sit and wait for the securitization markets to open? That is obviously there's an element of risk there, because they've got to take a call on when they may open. And then secondly, the payment holiday issue. So talking about those cash flows, and I suppose it's an unintended consequence. And I think the intent behind what the banks, the Bank of England and the Treasury were doing is correct, that we don't quite know the extent of the payment holiday. So, and this is something that lenders are being asked to borne. So for non-bank lenders, not only are you taking the hit of a higher cost of funding in a down market where there's lower levels of volume, and then at the same time, maybe 5%, 10%, 20%, 25%, 30%, maybe more of your borrowers are going to be taking a 3-month payment holiday, and that does impact cash flows. And it's too early to say yet how large that is, but it is significant. And that's another reason why I think a lot of lenders are just sitting back, hoarding capital to some degree until they see the extent of these payment holidays, because it could be very, very significant. I mean, I spoke to one person from a high street bank who thought it might be as high as a third or 40% of their loan book who at some point uses payment holiday, and that does, you know, have an impact on the funding environment.
I think as well, if you look at if you just look at the measures that the government and the Bank of England have put into the system. So if you look at a macro level at the banking system and the mortgage market within that, there's a huge amount of support available. And this has gone in very quickly. So again, if you compare with 2007-8, it was quite some time before we had the funding for lending, special liquidity scheme, term funding schemes. This time, they have not hung about at all. So they've implemented liquidity schemes to support the majority of the banking building society market, not non-bank sector, that's for sure. But they've done it quickly, and they put in another lot of support measures. So it's not just payment holidays on mortgages, it's the furlough scheme for employees and so on, HMR schemes on deferring payment of taxes, etc. I think it's going to be bumpy for a while, but the government doesn't seem to be hanging around in providing liquidity and other support. I think just in relation to non-bank sector and the lack of funding for the wholesale funded entities, we have been here before. When I was chairman of IMLA last time, this happened, and we engaged directly with the Bank of England and the Treasury to try and get support. And that is happening again. I'm certainly aware that IMLA and others are lobbying for attention into the non-bank sector. It's not there yet, but to be fair, there are so many issues for government, treasury and regulators to deal with. It's not surprising, but this is happening at a pace.
Certainly, and we've got some more questions coming in just on that issue. Jack Bertoloni from Brooklands Commercial Finance wants to know what the immediate impact has there been on lenders' ability to raise funding?
Yeah, well, I mean, as I say, I mean, in terms of non-bank lenders, the capital markets is effectively closed, both from a warehousing, getting new warehouses, and securitization. So it's an extremely challenging environment. I think it's very interesting to actually look at what the Australian authorities have done. What the Australian authorities have done is they've come in to the capital markets and been a buyer of bonds within securitization structures. And to my understanding, not just the most senior notes, not just AAA, but some of the mezzanine notes as well. So that's actually supported the securitization market in Australia. They've only just started doing it. It's I think a week in or so. So it's early days, and I don't know the extent of the commitment in terms of the amount of money they're putting in it. But if that would be a bit of a game changer that would really breathe some life into the market, because I say it's a double whammy at the moment. Non-bank lenders are getting more expensive funding, but also they're taking this hit on the payment holiday. And in addition to that, they're testing their business continuity plan. So, and it seems to me that generally, and this is a generalization, that the non-bank lenders, which on the whole are slightly more modern companies and newer companies, probably have better infrastructure to be able to work from home than a lot of the high street banks who actually are struggling to actually operate. So those who have the most flexibility operationally are probably the ones that have the most funding issues for mortgages, whereas obviously those that can access the funding from the Bank of England probably are less well coped to fund it, which is a bit of an irony. Obviously, we're going to come on to the issue of valuations, but it's very hard. That's one issue that is affecting everyone. How do you value a property when people can't visit the house?
Yeah, the other thing to add, apart from the Australian news that John was just reporting, is last week the European Central Bank announced that they'd launched their emergency purchase scheme, and this is going to be in place at least until the end of this year, I understand. So it's a significant extension of the existing program, and this will allow them to go in and purchase ABS and residential mortgage-backed securities. So it'd be great if the Bank of England facilitated something similar here, other than just through their sort of current term funding scheme, which isn't open to all.
Okay, I've got a question coming from Sham Villani from 21st Century Mortgage Finance, and he wants to know whether coronavirus has affected your own funding position, John, and indeed your lending appetite.
Well, like a lot of lenders, we've reduced high LTV products. Our funders have taken a view that they need to sort of de-risk and slow down, partly also because of the cost of capital, as I discussed. So I think we're in exactly the same boat in that sense as other non-bank lenders, that we don't quite know. And again, we're going to come on to valuations, but to right now be lending in a 75% LTV, 80% LTV, we expect there to be a drop in property values. What we don't know is by how much. So if you're lending at 75% LTV today, you might find in 2 months that loan is already above 100% LTV. And so I think I'm right in saying that the vast majority of lenders then are pulling back those high LTV products, and we and our funders are exactly the same. We've got to be prudent, particularly when the capital markets are as they are.
Okay, another question here is from David Tonks from Advocate Finance. David wants to know that with so much capital, and many brokers will want to know this, with so much capital and liquidity in the market, why are some of the biggest lenders closing their doors or seemingly closing their doors?
So I think it's a number of things, really. One is, in no particular order, conservation of capital and liquidity. And yes, I know the larger banks have actually awash with support on this, but some of it will be conservation of capital and liquidity. Secondly, we've already discussed the change over to remote working, and John's just talked about some of the more established larger players actually ironically don't have the best systems or frankly huge infrastructures to put into a remote working, so we should sympathize with those. So an awful lot of that, new processes to meet customers' need, payment holidays, etc. So I think protection of the business in the early stages, and actually moving working processes and protection of existing customers is a lot of what you've seen, I think. So if I'm right, as we move through the phases, this will start to ease up a bit.
Now, moving on to valuations, this is a very important subject at the heart of our businesses. I've got a question from Dak Lamb from Sirius Property Finance. And he wants to know that with the reduction of LTVs to 60% for Landbay, are Landbay going to be allowing desktop valuations? And to add to that, I've got Mike Cole from My Mortgage who wants to know whether across the board, we will see more desktop valuations in future when things eventually settle down.
So in relation to Landbay, and again, I think this will be quite common across the industry, for mortgages to be securitized, it is very challenging to do desktop valuations. You need either, if you don't have physical valuations on every single property, regardless of LTV, regardless of remortgage or purchase, etc., either they are not really securitizable, or in effect, a heavy penalty is applied to them from the rating agencies and buyers that will then question the validity of those valuations. So in a time when the securitization market is closed, to put yourself in a position where actually, if we get to a point where we can come to market in an expensive, we're penalized even more because there has been an absence of physical valuations. It just makes that, in that funding structure, even more uneconomic than it is today. And particularly for US investors and US banks, etc., to be involved in securitization, I think under Dodd-Frank, they have to have physical valuations. It doesn't really matter, even if they're 20% LTV, the US Fed or the US government has insisted that they do it. So it's something we are, and I'm sure all lenders are, we're looking at how we might be able to incorporate it in the future. But right now, in terms of as it stands, we have no ability to. And I think, as you've seen from other lenders, particularly non-bank lenders, that they're all in a similar position where, you know, that they're not instructing valuations, whatever the LTV, whether it's remortgage or purchase.
Can I say something on that as well? I think I was struck by some of the similarities, but for different reasons, as we emerged out of the credit crisis and markets. So 2012, 13, 14 started operating again. We actually had a shortage of valuers in the market. Well, we have a shortage of valuers in the market. Average age of valuers today, I think is around about 60. So it's the aging population of valuers. And so we were seeing shortage of valuers 2013, 14. One of the outcomes for that was use of AVMs, use of desktop valuations by some of the largest lenders. And I think it's got lenders thinking about what are the properties that, or what are the, where are the real risks and where do we want to focus our time? So I think you could make a case for standard construction properties nowhere near high risk areas like floodplains, mining and subsidence, in or around sort of conurbations where the economy is easy to understand, having some sort of desktop type valuation, or maybe supported with an AVM, particularly if the LTV is low. And then you focus your efforts on those cases where you really do need to have a valuation, where it doesn't fit any of the above: larger loans, higher LTV, non-standard construction, higher risk areas. And I think that has been the case for a while. And I think maybe this is just going to exacerbate it and maybe get some focus back on that again. There have been a lot of technology moves in the valuation markets in the last 5 years. And I think we could do with some more of them. So yeah, I expect some changes.
Okay, sticking with that valuation point, John Nixon from Dynamo wants to know what the post-COVID-19 mortgage process is actually going to look like from a valuation standpoint, and could this change the industry permanently? What do you both feel about that?
I still think for a lot of properties, a physical valuation will be required from funders and will be the norm. And actually, on the chat that I've seen, a few people asked about whether a drive-by or having the borrower take photos themselves would count. And right now, that it wouldn't count. It needs to be, you know, a RICS qualified surveyor enter the property, take a certain number of photos, go into every room, etc., etc. So at the moment, there are no shortcuts. I think, as Tony said, we may, over time, post-crisis, see more use of AVMs, because particularly banks now who want to lend at 50%, 60%, particularly on remortgage or retention products or product transfers, then they're probably going to start getting used to AVMs in those LTVs, and it may well be at that point they're here to stay. Particularly, as Tony said, if they're standard properties, they're not next to commercial units, sensible LTVs, etc., and there's a lot of comparables. And you've got to remember that the other challenge we have with AVMs aren't such a technology; they're a use of data. And as we go through this crisis, there's going to be less and less property transactions, and so you've got to bear in mind that actually, therefore, the comparables become less relevant because they become more historic, or there are less of them. So arguably, AVMs could become even less reliable over the next few months than they might have been, say, 2 or 3 months ago.
Okay, I've got a question that's coming from Ellie Broadhurst from Bayer Financial, and she wants to know whether those lenders will find an alternative to actual valuations, or whether everything's going to have to be just put on hold. What do we think about that?
Yeah, so I suppose I'm not sure we've caught up with reality yet. The reality is we're all trying to focus on how to carry out business as usual in difficult circumstances. I think the reality is we've got pipelines, not all of which are going to complete. So yes, we'll look for solutions to get the pipelines through. I expect to see no activity as things stand on house purchase at all. How can there be any house purchase transactions? There might be some remortgage activity, but pretty muted. So I think at the moment we haven't really quite adjusted to what we're doing. This is the early phase that we're still going into the lockdown, and the fact that transactions while we're in this lockdown are not going to be normal. And so trying to get a valuation may be the last of your problems in a way once we've got the pipeline sorted out. I think we have to wait until we start to come out of it before it becomes more critical, really.
Okay, I've got a question here that's coming from Stephen Court from Finance for Business. And Stephen wants to know whether underwriting requirements and risk appetite will alter in the short to medium term until normality has resumed.
I think yes. In the short term, I think it will. And again, it's partly because operational purpose as well. And I think until we see where what happens to the housing market, and actually what happens to the housing market is really a result of what happens to the economy, what happens over particularly the next 2 quarters, because I think unlike 2008, 2009, I don't think this is going to be something that goes on for years on end. I could be wrong, but the biggest impact is likely to be over the next 6 months. And so what's going to drive things within the market? Well, it's confidence, which obviously right now is going to be very low. It's unemployment and GDP. And so until we get a sense of actually how unemployment, how GDP impact, then we can sort of get a sense of, well, what is the demand for rental properties? What is likely to happen to property prices? And so I think there is that window where we're all sort of operating in the dark. And naturally, as we've seen with Brexit referendum, we've seen with various things, an election, when there's uncertainty in the market, and this uncertainty could be very material. So, the investors and people that buy mortgages that are taking on risk just sit back and want to de-risk, and that is sort of fairly rational behaviour. In 2008, 2009, over a 15-month period, UK GDP fell by around about 6%, just under, I think. Some people are predicting that GDP will fall by more than that in this quarter alone. Oh, sorry, I think Q2 this quarter. So that's why I think people will just wait and see, dial down risk in the short term. I mean, one thing I would say in terms of that's very different to the crisis, last time around, the lending and high risk lending was the cause of the crisis. This time around, it's not. So one thing I would say is, getting through the short and medium term, I suspect that broadly speaking, we will get back to the sorts of lending practices we were at once we're through this crisis, whenever that might be, because actually, generally speaking, there was not that much high LTV lending or risky lending going on, particularly because what the FCA had done, MMR, and the PRA had done in the Bank of England. So I don't think we're going to see a permanent reset of risk appetite, but there will be one in the short term.
Agreed.
One of the common themes coming through to us in the chat questions here are, how long is this going to last? Do we think, and what's going to be the overall impact on property prices?
Well, until this is an it's an economic crisis that's caused by a public health crisis, and the economic crisis is not going to be over until the public health crisis is over. And so there's only really two, and that means that until work can go back to normal, that pubs can open, restaurants can open, people can get on public transport without feeling at risk, et cetera, that it's safe to go back to work, then that it's not going to finish until then. And that either means a vaccine is available, or that we've developed serious immunity, or whatever it may be. Now, there may be gradual steps back where after a certain time, the government relaxes some of the current measures, and there's a little bit of a recovery where things can sort of normalize to some degree. So pubs can't open, but workplaces can, or whatever it might be. But it is all tied to the health side of things. That while the economy wasn't growing fast in Q1, I think we all came back, lenders and mortgage brokers, after Brexit had been settled, and I say that in inverted commas, but we knew where we were going. The general election had been settled, and I think we came back January, February, all quite confident that while the GDP wasn't going to be an amazing year, it was going to be a pretty decent year for the mortgage industry. And then this came, and has been probably will have a bigger impact on short-term GDP than anything that's happened in our lifetime.
Good. Listen, we've had a little bit of a chat about payment holidays before, but specifically, I've got a question here from Ertash Ali from Vincent Birch, and he wants to know whether taking a payment holiday really is advisable, and what effect this will have on mortgage payments. Well, what effect taking a payment holiday will have on any future lending requests. John, do you see this being a bigger issue going forward?
Yes, I think it will. I think it will probably be a bigger issue in the home loan market than buy-to-let, but I think it will be significant in both. To be clear, one thing I would say actually is, whatever your clients and borrowers do, don't just think, oh, I've read I can take a payment holiday and cancel a direct debit. Lenders will treat lenders and credit reference agencies, if you do not arrange it with the lender, then that will be treated as a missed payment if you just cancel a direct debit unilaterally. So that is very, very important to note and to pass on to clients. In terms of, it's not going to affect, the credit rating agencies have said that it's not going to affect your credit history. But however, within the buy-to-let market, obviously a lot of the buy-to-let special lenders focus on portfolio landlords, people that may have 4, 5, 7, 8, 9 properties. So if we have a borrower right now, and this will apply to all buy-to-let lenders, one assumes, who has 2 mortgages with us, and he has another one, he or she has another one going through the process now, and has asked for a payment holiday on the 2 that they already have, he or she has basically told us that they're in financial distress. And while we can grant that holiday, as a prudent, sensible lender, do you think we can then give them a further advance on the mortgage they've got going on? I suspect a lot of lenders will say, well, actually, no, if we'll have to halt any offers or completions in that scenario. We've also had, and I'm sure a lot of lenders have had, situations where before a loan is even completed, we're getting questions about, will you grant payment holidays? And so you'll think, well, actually, before they've even taken the loan, they're already thinking about taking a payment holiday. So I think you have to be careful. The purpose of a payment holiday for buy-to-let lenders is there that if your tenants are put out of work, it's there for the tenant's benefit, to ensure that they're not evicted. It's not a free, oh, I can get 3 months liquidity for free. And it will have to be paid back. It's added to the loan, et cetera, et cetera. So I think, do think carefully about it and don't abuse it.
Sticking with payment holidays, I've got a question here that's coming from Andrew Montlake from Corico. And he wants to know whether in general, lenders are going to be able to cope with the level of payment holiday requests that they are currently receiving? And indeed, what is the knock-on effect going to be if in effect they are all granted?
It's both an operational impact and a funding and liquidity strain, isn't it? So operationally, I think they're going to be stretched, some more than others, but very stretched. From a liquidity point of view, well, we've talked about that. One thing to note, though, is where loans have been securitized, I'm not aware of any securitization that was designed with these payment holidays in mind. I mean, these structures are put together very carefully, and they simulate all sorts of downturns and significant downturns, levels of arrears, and they have liquidity funds to deal with all of these. But actually, that was all set aside one Friday afternoon, I think it was, when it was announced 3-month payment holidays were going to have to be invoked. Now, these deals don't contemplate that. They don't have liquidity support facilities, and I'm not even sure it's allowed under them. So those ones, I would imagine entities funded by those will struggle to actually implement them. Operationally, I think it could become overwhelming as time goes on. And it will be the trouble is, it's trying to determine what's a frivolous request for assistance and what's real. And there are not too many ways, not too many questions a lender can really determine whether it's frivolous or not. John may have practical experience on this.
Yeah, I think, and again, we're not a balance sheet lender, other investors have a balance sheet, but I totally agree. It is affecting the credit rating agencies. Don't know how to deal with it because they have no reference point in terms of expectation. Thinking, well, is this going to be is it 5% of the pool? Is it 10%? Is it 15%? What sort of borrowers are more likely to request it? Is it buy to let? Is it homeowners, et cetera, et cetera? Is it first time buyers? You know, there's no data on it. And you know, you end up, the likely outcome is you end up creating a spike of what is effectively a 90-day arrear pool without them being classed as 90-day arrears. And it will be significant. And arguably, if you were to classify it as a 90-day arrears, I suspect on a lot of securitizations, it would be higher than what would have happened in 2008, 2009. Now, they're not going to lead to repossession. They're unlikely to lead to losses. But again, it's one of those things that will spook investors when they sort of see what percentage this could end up being.
Yep.
Okay. Now, we've seen LTVs tighten across the board, and even some lenders put a halt to new lending for their own various reasons. I've got a question here from Manish Gajar from Prosper Home Loans, and he wants to know when we can expect lenders to resume normal lending.
As I was saying earlier, I think that the market was in quite a good place a few months ago in terms of risk. And that's partly because of MMR. It's partly because of what the PRA did in buy-to-let, and obviously we're a buy-to-let lender, so I know more about that than the home loan market. And therefore, you know, we saw very little lending over 75% LTV. We ourselves, we had an 80% product. We did probably somewhere 1 to 2% of our volume on that, and that's because the affordability metrics that the PRA brought in make 80% very hard to work particularly in the southeast. And so actually from a risk point of view where people are sitting on LTVs and affordability, I think broadly speaking, not much will change actually from the types of products that you see. There might be certain things where people were starting to move into things like mixed use commercial that people might now see as higher risk, holiday lets or Airbnb lets, they might suddenly take a sort of harder view on. So there may be some product, but the core buy-to-let market, I don't think there was anything too risky going on. The question of when, again, until we get to a point where most people can operate normally from a working point of view, valuers can go and visit properties, restaurants are open, and therefore, you know, unemployment, and again, we haven't seen unemployment numbers yet, but people can largely speaking get back to work. And again, well, that largely depends on, you know, public health, vaccines and stuff that I don't know about, I'm afraid.
Yeah.
Well, we talk about this resume to normal lending, but what about if this is the new normal? What about if things don't change for the next, say, 3 years?
They can't last 3 years. It's not possible. we as a country will be bust long before then, along with the rest of the world. So I think any notion that we're going to be doing this for 3 years is just not possible. So this is for a limited period of time. We just don't know what that period of time is, but it's not 3 years. So there has to be some sort of bounce back. I think the question is, when we come out of this, either through medical science, herd immunity, whatever the public health measures are that bring us out of this, is whenever that is, how quickly do we resume what we were doing in January? And will the world look pretty much the same? And I'd say it won't, because actually the effect on global economies is going to be so significant over this period of time, and not just ours, and of course impacts on other major economies like the US. It will have a global drag on things, but so we shouldn't expect to go back as we were, and I don't think it's just going to bounce back and everything will reassert itself. FTSE won't go back to where it was, because we've seen companies suffering real losses and hardship in that period of time.
Well, certainly the post-COVID-19 world is going to look very different. Mandy Waby from Veracity Financial Planning wants to know whether you think lenders will be looking to lend with the same LTVs if house prices have fallen, and whether HMOs will still be an attractive option for lenders in the post-COVID-19 world.
I would have thought, Karen, John.
Yes, I suspect so. Again, it does depend on that funding piece as well. But in terms of capital markets being in place, but I suspect the demand for rental properties will continue, will exist, both HMOs and single unit blocks. And again, whether people go straight back at 80%, maybe not, but let's say I think there was very little lending done at that point anyway. So I do think in terms of that LTVs getting back to 75%, and lending on things like HMOs, multi-unit freehold blocks, et cetera, I suspect that will return once we return to normality, however you define normality.
Yeah, so I would supplement that by saying I think there's going to be strong demand for rental property, if anything, stronger after this than before. So I think the demand is going to be there. I think the other thing is we'll just have to look at the buy-to-let sector and how it performs as a credit. Now, the PRA, Financial Policy Committee, and so on, they've been very down on the buy-to-let market. They think it's high risk, but the data over the last 24 years that buy-to-let's been around has consistently been good. And I think with one exception back in the credit crisis, it's performed, its arrears, 3-month arrears data has been half what it is in the owner-occupied market. And I don't see any reason why this is going to be any different. And I think finally, if you look at lenders need to lend, that's what they're there for. That's their purpose. And if you look at, well, which assets do you lend to? Mortgages are the biggest asset class in the world. And as many of you will know, the UK is the second largest mortgage market in the world. It's the biggest in Europe. And buy-to-let and residential mortgages, 80% loan to value and below, come in for pretty low capital risk weightings. So if you're a bank or a building society, it's a big asset class. It's one that's embedded into the economy. It performs well, and you don't have to put that much capital up against it. Why wouldn't you be lending at or below 80% back into this market? We'll have to start lending again. That's the raison d'etre for these companies.
Very, very good words. Service levels have been causing lenders certain issues. Samuel Daly from Spencer James Financial makes an interesting point. He wants to know that with the COVID-19 virus meaning lenders are forced to make key staff members work from home and creating alternative working practices, will this potentially become an industry norm going forward? And in doing so, will that create a better service, or mean a better service is provided through greater efficiency for clients over the long term?
Well, again, talking about Landbay, we did have a small number of people in our business that did work maybe 1 day a week from home. So there was some element, or 2 days a week. So that we had some flexibility beforehand. obviously, sales team, while they work from home or work from the field, and are not office based as well. So a lot of lenders are set up to have that capability. So it'll be interesting to see. It's not something we've discussed what happens when we return to normal. We're focused on probably just getting through operationally the next few months. So it's something we'll look at. But one thing I would say is I sense that we're, from Landbay's perspective, we're about a week and a half into everyone working from home. Most people now, though, have been working from home for about 2 weeks at Landbay. And I suspect that's similar across the industry. I suspect that when the restrictions are lifted, I think people actually will want to go back to the office. I think people are already finding it quite tough working from home, miss the social interaction, et cetera, et cetera. I may be wrong, but I would. I think people are itching to get back into the office and actually be with their workmates.
Okay, I've got a question here that's coming from Richard Purnell from ME Smarter Mortgage Service, and he wants to know whether, once businesses can function in a more normal environment, do you see any longer lasting changes to rates, LTVs, criteria, and indeed the general availability of buy-to-let mortgages?
So I think we're going to have long-term low interest rates. So in fact, we've had long-term low interest rates for a while, and I think COVID-19 has actually, if anything, it's pushed them lower for longer. So that's the first thing. Interestingly, as part of the Conservative manifesto, they were very keen on having long-term fixed rate mortgages, which I didn't think would succeed. And in fact, looking at long-term low interest rates now, you could argue we'll have them whether you go into a long-term fixed or not. I would like to see, and this may seem like a really strange thing to be saying very early into this crisis, but this term funding scheme that's being reactivated, absolutely know why it's there. I think it's a good thing. However, we needed to get off the last scheme because until you can have markets functioning normally using core funding mechanisms to make them work, you have a dysfunctional market and a dysfunctional housing market and economy. And so I know why TFS has been put back in, but we need support for core funding like cover bonds, mortgage-backed securities, and retail's funding is fine and it's embedded with enhanced financial service compensation scheme provisions. So we all need to get off TFS and get back to normal as soon as we can. And we were just doing that, and now this has happened and set us back.
Well, sticking with the post-COVID-19 theme, at some point, we all hope that the virus will go, but according to experts, this could well take many more months than we initially thought. I've got a question here from Tony O'Sullivan from Buckinghamshire Mortgage Company, and he'd like to know, well, the golden question, I think, how long do you think it will take for the UK to recover from this financially?
Well, I think there are two aspects to that. I think there's the sort of economic activity aspect, where, like I say, people largely go back to work. They go on shopping, going to the cinema, going to restaurants, effectively as they were in February. And I suspect that recovery will happen relatively quickly once we actually get back to work. So I think there will be this bounce back, whether it's 6 months, 9 months, 12 months down the line. However, over that time, as a country, we would have built up potentially hundreds of billions of debt as a country over that short period of time. We know we need to fund the NHS more. So I think in terms of the country getting back together, in terms of financially and sorting out that side of things, then that's probably with us for a generation or so.
Agreed. Don't underestimate the colossal financial impact on the UK and other global economies. This lockdown will be everything, because the government kitchen sinks this to do whatever it takes to keep the UK running, and other countries around the world are doing their own version of that. So you can do that for a while, but not forever, as we discussed earlier. So the politicians have got a tricky job, because as Boris keeps telling us, he's following the science and he's scientific advisors, which of course he is, but he will be having to weigh up against that the of course, the health of the nation, the ability for the NHS to cope with spikes of people, plus he has to balance that against the long-term economic damage, which is undoubtedly being done today. So it's not an easy one to balance. And it's the one that Trump, I think, tried to call early on in this by saying it wasn't such a big issue and we'd all overestimated it. But we're only going to know at the end of this whether we got that balance right.
Okay. Just returning to the buy-to-let market, and I guess from your point of view, can only be described as crystal ball gazing. Peter Steele from Goldberg Steele Financial Services would like your thoughts on where you think the buy-to-let market might be in terms of fluidity for buying, selling, and rental incomes, and indeed mortgage availability, where that will be during the next 3, 6, and 12 months. Slightly optimistic, I feel.
Well, yeah, certainly. I think in the first period, 3 to 6 months, I think we're going to see very little very little activity within the buy-to-let market. Obviously, the purchase, as Tony's implying, purchases are virtually impossible to do. Certainly 3 months, I suspect 3 to 6 months as well. And even if you're trying to rent out a new property over that period, I suspect it's very challenging. So I think that 3 to 6 months in all those, we're going to see pretty much just a remortgage market only in that space. I do think longer term, once we get through this, that as we were talking about earlier, there will be more demand for buy-to-let. There'll be, I think there may be on the home loan market a slight reduction in LTVs. Some lenders may be slightly more prudent. There's going to be increased demand for rental property, and also if there is a short-term fall in house prices, and it's very hard to sense what that will be and for how long. But you know, in the general financial crisis, it was circa 20% on average. If it's something similar, and it may not be, it may be less than that, it may be slightly more, but that sort of quantum where typically you find that rents don't fall anywhere near in line, that they're a lot less volatile than house prices. So if you get a situation where house prices do fall 15% and rents fall 5%, then actually, obviously, the yield that's sitting on a buy-to-let property, assuming that you can still get a 75% mortgage, has improved. So I think the demand side of it is there, and again, obviously, the supply side, if those yields improve and there are investors that are able to go out and attract, then you may see a tick up in purchase activity, whether it be towards the tail end of this year or 2021. I don't know, and I wouldn't like to put a date on it, but I think once we get through it, I do think actually there probably is that there is potentially increased activity. But let's say, some of that will be just catching up on activity that's missed out over the next 6-month period.
Okay, just move forward a little bit. Once the UK market starts to recover, whenever that is, are there any areas of lending that you think will be quicker to bounce back than others?
Ironically,
well, I was going to say, are there any areas that you feel we might have been overconfident pre-crisis that might struggle to return?
So I think buy-to-let will bounce back. I think I'm optimistic about the buy-to-let market and the demand for rental property. And if anything, I think it'll be stronger after this than before. The other market I was thinking about was the first-time buyer owner-occupied market. And it could be a mixture, but ironically, we may see, depending on what happens to house prices and jobs, but houses may become more affordable for first-time buyers as a bit of an offset to the rental sector. So those two to watch, I guess.
Okay. Now they say hindsight is a wonderful thing. Steve Bond from the Principality wants to know if there are perhaps any fundamental changes that were needed to be made by mortgage brokers and mortgage lenders prior to this crisis, and whether these will now be exemplified.
Yeah. So I think one of the things is, however bad we thought it would be in terms of our contingency planning for some major disruption like this, it's probably been a lot worse than we thought. So I think one of the things is preparedness for businesses in a crisis and in contingency planning, looking at your technology and learning from this. I think annuity income is another one. For brokers and lenders, business models that depend on writing business, you have to run to stand still, is actually dangerous. Most broker businesses are built like this. Most lender businesses are not, but some are. So trying to have some annuity income that in a downturn in the market, you're not sitting there with all of your costs pretty much as they were, and your income not coming through the door. So I think looking at how to split income between front end income and some sort of longer term annuity income. And actually what I'm talking about here in terms of prop fees is maybe sacrificing some of the front end prop fee for a long-term share of the profits and aligning the interest between the lender and the broker, something I've believed in for a long time. There's very little of evidence of it in the market. I think for lenders, diversification of funding, it's obvious really. It was the same before the crisis, but it's now for all to see. For all lenders, diversification of funding and funding sources, not just the entities you're getting your funding from, but it's the type of funding. So a mixture of wholesale and retail funded. So I remember in the credit crisis when the bond market shut in 2007-8, the regulators were saying wholesale funding's bad. And I was saying it's not bad, it's just not there at the moment. And retail in itself is not particularly good on its own. It's inherently short-term funding longer-term mortgages. What you need is a range of funding. And so I would urge all those lenders that don't have a range of funding, sources and types, to look at that.
Okay, we're coming to the end now, but finally, this is a global crisis and we are pretty much all in this together. What business advice would you give to those watching today?
Well, from my perspective, I think in terms of short term for brokers, all businesses right now, we don't know how revenue is going to be impacted, or you don't know how revenue is going to be impacted to what extent over the next 3 to 6 months. But one thing's for certain, it's not going to be going up in our market. And so I would very quickly focus on costs and really try and remove any cost that's not necessary in the short term. Look at some of those government schemes as well. So that's really important. Keep things really to the minimum until you know what's going on. And also, we've talked about there's not going to be that much activity in the mortgage market in the next 3 to 6 months. Part of that is obviously the purchase market's going to stop, but also this valuation issue is part of it. And then some of the bigger lenders have operational challenges, and some have a combination of all those things. So I think now is a time to really focus on your relationships and play the long game. Just focus on key relationships, talk to clients, talk to advise. You're not going to get money out of it. It's not going to be transaction right now, but be there to advise them on all sorts of things as the best you can over the next few months, and then that should pay dividends in the long term.
Yeah, so similar. I'd say take out all of the costs you reasonably can to protect your business right now. Utilize all government schemes available. Key thing, keep all your teams involved. This is not something that we've caused. We're all subject to it. And actually, it's in all our interests to get to the other side of this, however long that takes. Make sure staffing teams know what's happening, how it affects them and why. Plan for the worst, hope for the best. Learn from things that haven't gone so well, for example, systems and technology we've talked about, and use this time to sort that out for the future. Work closely with funders, equity investors, key business partners, and for those of us who can, with the government, the Treasury and the regulators, because they are dealing with so many things at the moment and trying to triage decisions to focus on the things that need most attention, and we can help them. So we're all in this together right now. I don't think competition, in my view, shouldn't be at the top of the list. It's in our interest as an industry that we should work together with fellow lenders rather than just go it alone in a maverick style. That would be my call for action to the industry.
And an interesting call that will be indeed. Well, thank you, John, and thank you, Tony, and thank you all at home for watching. I've found all those comments both interesting and insightful, and what a very certainly strange, challenging and uncertain times for us all. Well, that comes to the end of this webinar hosted by Landbay and in association with Mortgage Introducer, and I do hope you have all found it useful. We'll shortly be sending out an email requesting any feedback, so if you can please fill it in and return it, together with any other webinar topics you'd like covered in the future. And a reminder, you can watch this broadcast again via various social media and also on the Mortgage Introducer website, which can be found at www.mortgageintroducer.com. I'm Robyn Hall, Publishing Director of Mortgage Introducer. Thank you, keep safe, keep well, and remember, stay safe. Thank you.
Thanks. Bye.